Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the confusing world of corporate finance by digging through their filings and uncovering the real story. Today we're looking at Vroom Inc. and let me tell you, they've made a deal that's got some serious convertible notes attached. So what's the big news? Vroom, the online used car seller, has just announced a significant financing deal that involves issuing convertible notes. This is essentially them borrowing money, but giving the lenders the option to turn that debt into stock later on. They've entered into a note purchase agreement with Accession Capital, LLC, and Robert J. Mylod Jr. This isn't just random money. The company says this deal is all about supporting their long-term business strategy. Now, for a bit of background, Vroom had a tough time during the pandemic, slump in car sales, and the subsequent economic challenges. They've been working to get back on track, and this kind of financing can be crucial for breathing room and enacting those plans. Let's talk numbers. Vroom is issuing $10 million worth of these convertible notes. That means two investors, Accession Capital and Robert J. Mylod Jr., are each putting in $5 million. Interestingly, Robert J. Mylod Jr. isn't just any investor here, he's also the independent executive chair of Vroom's board of directors. That's an important detail to keep in mind as it brings up questions about potential conflicts of interest or at least a very close relationship between the lenders and the company's leadership. Plus, he's the managing partner of Accession Capital. Now for the convertible part. These notes not only pay interest but can be converted into Vroom's common stock. The conversion price is set at $35 per share. Think about it this way. If Vroom's stock price goes above $35, the lenders can choose to convert their debt into stock, which would then be worth more than the debt itself. This is a way for the company to potentially raise equity capital without immediately diluting existing shareholders excessively if the stock price is expected to rise. Here's another key point. This deal is happening outside of the usual public market registration process. They're calling it a private placement and are relying on exemptions like Section 4A2 of the Securities Act. This usually means the investors are considered sophisticated or accredited, meaning they're wealthy enough to understand and bear the risks of such investments without the full protections of a public offering. And who signed off on this? Jonathan Sanderson, the Chief Financial Officer for Vroom Inc. This tells us the deal is official and has gone through the necessary internal approvals. Now, let's think about what this means for Vroom. On one hand, securing $10 million in funding is positive, especially if they've been struggling with cash flow. It shows that there are investors, including those closely connected to the company, who believe in their future strategy. The convertible nature of a double-edged sword. If Vroom's stock price performs well and surpasses that $35 conversion mark, it could be a very efficient way to pay back debt with equity, potentially strengthening their balance sheet in the long run without needing to raise cash through a public offering at potentially unfavorable prices. However, we also need to consider the risks. The fact that a major investor is also a key board member raises questions. Is this the best deal the company could have gotten in the open market? Was the conversion price fair given Vroom's current stock performance and prospects? It's a common practice, but it always warrants a closer look. Also, the success of this financing hinges on Vroom's ability to execute its business strategy and improve its financial performance. If the stock price doesn't rise above $35, this is simply debt that needs to be repaid with interest, and that could strain their resources if sales don't pick up significantly. Looking at Vroom's broader situation, they've been in a challenging market. The used car industry experienced huge volatility. While demand surged during the pandemic due to new car shortages, it has since normalized and competition remains fierce. Vroom needs to demonstrate a clear path to profitability and sustainable growth. This financing is a tool, but it's the execution of their strategy that will ultimately determine if Vroom can turn things around. The company's ability to manage its inventory, control costs, and effectively market its services will be critical. So what's my take on Vroom's recent move? On the surface, it's a necessary step to fund operations and strategic initiatives. The involvement of a board member as a key investor is a significant factor, and investors should scrutinize the terms closely. The convertible notes offer flexibility, but the real test will be Vroom's performance and its stock price development. If they can navigate the competitive landscape and hit their targets, this could prove to be a smart move that sets them up for future growth. If not, it's just more debt with a conversion kicker. It all boils down to execution and market conditions. Alright, that's our breakdown of Vroom's latest filing. What's your take on these numbers and what they signal for the company's future? Do you think this convertible note deal is a good move for Vroom? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.